Hey everyone, welcome back to Poplar Preparedness. Today I want to talk about some SHTF investing. I am not an investment advisor. I am not certified in anything along those lines. I am just a concerned person and I want to share some information. So you need to do your own research, but hopefully I give you some ideas and some questions and some thoughts that you can think over and do your own research, and you can ask, if you have an investment advisor, to ask them these questions, because I think there's some things that aren't really being considered. And so I just want to throw some stream of consciousness thoughts about investing to you. First thing is that, as many of you already understand and know, is that if you don't actually have possession of something, you don't really have ownership, right? What's that? 9/10 of ownership is possession. Possession is 9/10 ownership. And that's true. If everything you have is just basically promissory notes or promises from other people to give you something because they're holding it for you, do you actually really have it? And that really means a lot when we're talking about things like precious metals. You know, the difference between somebody promising you that they have your gold or silver in a vault somewhere, but you're not actually able to go and claim it. You're not allowed to go pick it up. You have to go through a process, and really they have options to just pay you out in cash. What happens if they just manipulate the price and then just pay you out the manipulated price? That's a real concern. Whereas, physical silver and physical gold can be worth this much above spot, a premium on there. But that goes for a lot of other things too. When you deal with contracts, when you deal with even ETFs and such like that, do you actually own the things that you think you own? That's a very real concern and very real question. And when it comes to bonds, what do you really actually own? Most of the time with bonds, you don't actually own anything. You just own the promise of income from this company. What happens if the company just decides not to pay? That happens, especially in market crashes and stuff like that. That happens. Now, when you own stock in a company, you actually do own something. So you do have partial ownership. It isn't a promise. Now, how that company is managed is a whole nother issue, right? So let's get into physical ownership of things. One, I think bonds are much, much more dangerous than people think they are. A lot of bonds, you can get zero from them. You can buy bonds that are quote unquote safe if you're buying them from companies that just choose not to pay you back, or they go into bankruptcy or they go to default. You might get nothing from them. And that's a very real thing that happens, especially in deep market crashes when companies start failing right and left. If companies are allowed to fail, bonds go to zero. And we see this in multiple places. You can go and back test this yourself. When you look at serious market crashes, look at how much bonds go down. This market crash that we had with the Big C, bonds, corporate bonds, I believe, went down something like, it was over 20%. They crashed over 20%, which is unheard of. Bonds aren't supposed to do that. Stocks crashed, bonds crashed. I'm not just talking about the high yield bonds, the junk bonds. I'm talking about stable corporate bonds. People realize that companies are going to be shut down and they won't be able to make money. And if companies can't make money, they can't pay their interest bills off, right? So a lot of people have built their portfolios where they have a certain percentage of stock and a certain percentage of bonds and a certain percentage of treasuries. Do you really think that the promises of the U.S. federal government are as stable now as the promises back 15, 20 years ago? That's an honest, legitimate question you should be asking yourself. Could the United States government default on its debt? It's a possibility. isn't it? Other countries have done it. Argentina's done it several times. This happens, especially when governments get so overextended. You say, well, they can control the interest rates, and we're going to get into that. But if interest rates go up against the federal government's manipulations, the bonds will actually start to crash. Treasury bonds, corporate bonds. And the simple thing is that if you can get a better interest rate somewhere else, why wouldn't people just buy those bonds? So how are you going to sell these bonds to somebody who doesn't even want them? You're going to have to actually pay a premium in order to sell that to them. And that's how bond prices can go down, even though you're supposed to be getting a set interest rate. If you're getting 1% interest or 2% interest, but then the rate goes up twice, the value of your bond just got cut in half. Let me repeat that. If the interest rate over your bonds doubles, your value of your bonds gets cut in half. If this is long term. Ouch. Ouch. Right? But that's how it works. If you're getting 1% or even 0.5% with your treasury bonds, but then the treasury bonds rate goes up to 1%, the premium on your bonds gets cut in half. So you need to think about that. As rates have dropped more and more, it's easier and easier for the rate to double, isn't it? And so when it doubles, you can see your bonds drop orders of magnitude down very, very quickly. And what causes interest rates to rise? Well, there's a couple things that cause interest rates to rise. The first thing is that people don't think that company or that government is actually going to pay their money back. And if that government or that company isn't going to pay their money back, nobody wants to buy those bonds. You're going to have a hard time selling them. Now, if you get a 30-year treasury and you want to, ride it out and cash it in after 30 years, okay. But how much is your dollar going to be worth then? I don't know. Most people buy bonds in order to sell the bonds before they come to maturity. And if that's the case, are you going to be able to sell them? The longer dated the bonds are, the more they are impacted by inflation and interest rates. So just keep that in mind. So all that to say, if companies and governments become seen as very insolvent or very possible that they're going to default, your stocks may actually hold up better than those bonds will. Because a bond, you don't actually own anything. It's just a promise. Whereas a stock, you at least own a share of that company. Now, the company could be mismanaged. The company could lose a lot of money, but you at least own something, right? Or at least the promise of something, right? So when it comes to physical silver and gold and such, you want to make sure you actually own something. Somebody's promised that they have it sitting in a vault. You have to ask yourself the question, have they promised that same bar of silver, that same bar of gold to somebody else? Fractional banking, right? When you have one brick of gold, but then you sell it to 5 people. It's not quite that straightforward because that would be criminal, but they effectively do that very thing just with more legalese and more finagling, okay? But they basically do the same thing where they're basically selling the same bar of gold, the same bar of silver to multiple people. And what happens if they all show up at the bank at the same time and say, I want mine? Well, there's stuff in the contract that makes it so that they don't actually have to give you what's yours. Yours. You don't have possession of it. It's not actually yours. They could give you a stack of worthless paper and say, there you go. We're settled. And you're going to say, I thought I owned silver. I thought I owned gold. And they're going to say, nope, Look at this contract again. That's not what it says. So make sure that you are actually truly owning your silver and gold. Now, here's the thing that some people talk about, but not enough people talk about, I think. Stock in mining companies. I think that buying silver and gold that's sitting in the ground still is a very valuable, worthwhile thing to do. I particularly like streaming companies. These are companies that basically are banks to mining companies, and they get promises of deliveries of silver and gold and other metals and stuff like that from the mining companies. They're the bank. So by buying shares of that, you get to be the bank for these mining companies. It makes money in the bad seasons, which mining companies tend to lose money most of the time. And then when there's a boom, they make money and make a lot of money sometimes. And sometimes so much economic damage has been done to them that they can't recover for it even during a boom time. So mining companies can be incredibly risky. But streaming companies, they make money even when the times are bad, which is nice. In fact, they actually make more money when times are bad because they get to loan money at just ridiculous rates to these mining companies because no one else will give them a loan. And they're taking delivery of future silver and gold from that mine, which could be worth a lot more in the future. You know, when you talk about ounces of silver and gold, when you're buying gold at $300 an ounce or $500 an ounce per the contract up to a certain number of ounces, if the price of silver and gold goes up a lot, those streaming companies have some really nice contracts and when that happens, those mining companies are actually going to have the money and the resources to actually pay out on those contracts too. So it's kind of a win-win. I like the idea of slowly making money in the bad times and then possibly making a lot of money in the good times. So there's some streaming companies out there that make a whole lot of sense to me. Once again, you're owning shares in that. They are promises on future deliveries, so there is that. But give that some thought. I do think that all companies are probably going to go down in value because things are just so overvalued. The S&P and the other stock markets are actually just incredibly overvalued. And it's worse than you know, actually. One of the famous things that they like to do is they like to compare the price of the stock versus the assets that they might be fooled into thinking you have a lot of assets that you don't have. Nebulous. It doesn't actually exist, but it's on the books there, and everyone's like, oh, well, see, it's not overvalued. It's like, yes, it is. 90% of the assets in the S&P companies are intangible. Now, some of those are hard assets like patents and products that are actually, or brands that are actually worth, but 90% of the assets that S&P companies own are intangible. And most of those assets aren't really anything. They don't really actually exist. So, is the S&P overvalued? Yeah, it is. Even if you were to take all those assets and count them all, it's overvalued to almost as high as it's ever been. It was a little higher in 2000, okay? But when you take into account how much of those assets are intangibles, it's unbelievable. It's unbelievable what things have gotten to. If we were to just liquidate all of the companies in the United States and sell them for the assets, the machinery, the parts, sell the actual functioning companies for a reasonable future earnings and stuff like that, the stock market would be down like 20-25% of what it is now. That's my call on it. I think that things are just tremendously overvalued. And you can disagree with me. I know a lot of people will be upset about that. And Like I said, I'm not an investment advisor. I don't think anyone would actually want to listen to my advice. What do I suggest? If you need to invest in bonds, do short-term bonds. Short-term so that you get your interest and everything like that. But I don't know why you'd even want to do that. If you're going to buy assets, you should buy hard assets, things you're going to use in the future, things that are going to go up 20 or 30% in the next couple months, like food and household cleaning supplies and stuff like that. If you still have more money, go out to the bank and buy boxes of nickels. You buy them for $100 right now, they're worth $120 in melt value. Melt value. They're worth more than that because they're stamped and everything like that. Go out and buy silver and gold. Go out and buy mining companies or streaming companies. Buy companies that are heavy in actual assets, not intangible assets, but like they actually own stuff, right? Because that stuff is going to increase in value. If you buy a mining company that has a lot of mining equipment, that stuff's going to go up in value. And just stay away from the companies that don't actually own very much. They just own their names. That's my opinion on it. Not a popular opinion, but I'm not a popular preparedness. I am Poplar preparedness, right? So God bless you all. Make smart choices. Do your own research. And have a great day. Steve Poplar, out.